Good day, and as always, the most interesting asset class out there, fixed income, and indeed it was a very interesting quarter. But it was also a very tough quarter. So we've had good returns over the last year or more from inflation bonds, but over the last quarter, because what's happened in China, China really got a bit of a cold and emerging markets felt it. So if we look at the returns, we can clearly see that there was pain in the longer end of the yield curve. So looking at the returns, cash gave you about 30 basis points, but longer dated bonds also gave you about 37 odd basis points. The real star performer in fixed income is inflation bonds, where over the last quarter you had about a 2% return. So great returns for those investors who stuck through tough times in the inflation market. I think it's also important to understand that, especially long-dated bonds is more of a 3-year investment horizon, and it's always dangerous to look at the short-term trends or returns. So if we think that over the last year inflation was sub 4%, you got about 12.5% from nominal bonds. So inflation plus 8.5 is still very attractive from nominal bonds. So that's very, very decent returns given the risk. The star performer, obviously, over the last year was inflation bonds, where you got nearly a 16% return. So it really paid off to investors to sit in that asset class and buy some protection. But you would recall from previous videos that I said that we couldn't make a call in investors making a decision between nominal bonds and inflation bonds. And we said that we really believe that investors should have a combination of nominal bonds and inflation bonds. And we are still sticking to that recommendation to clients. Why? Because you can clearly see that we are getting into a volatile world where, yes, nominal bonds are cheap and inflation bonds are still cheap as well, but they obviously move in converse ways. So when the sun is shining on emerging markets and what we call the risk on trade and money flows into emerging markets, then nominal bonds rally. But if we have a repeat of what happened in September, where there's issues in China, there's worries about the Fed hiking interest rates, emerging markets sell off on what we call the risk off trade, well, then inflation bonds are going to outperform. So we're still saying to clients, please don't just pick one of these asset classes alone. Really have a combination of nominal bonds and inflation bonds in your portfolio, or invest in a flexible fund that is exposed to both asset classes. As you would know, our motto at this point in time is that investing is personal with us, and it is personal for us in fixed income. Just like everybody else there, we are feeling the pain of the higher petrol price and all the prices that is rising in South Africa. And no wonder the SARB is worried about it, and that we are talking about interest rate hikes from early on in 2022. But we don't think that SARB is going to materially hike rates in a very short space of time. We think it's going to be a low, slow rate hiking cycle, maybe 2 to 3 rate hikes in 2022, and then let's say another 2 or 3 rate hikes in 2023. But the jury's still out, especially on the 2023 part, because the economy is still in very bad shape. We need to get to pre-COVID levels before the SARB will probably feel comfortable to hike the repo rate to a more, what we call a neutral level or normalized level, which we actually don't know where it is. So what we're saying is we still believe that over the next 2 to 3 years, there's going to be very good returns from nominals and inflation bonds in South Africa. And we think on a risk-adjusted basis, it really makes sense for our investors to be invested in those asset classes, and that you can have good real returns, inflation returns after inflation at low risk in the fixed income markets. And we would still recommend to clients to not sit in cash and rather be in duration assets, because that's where we feel the most value can be returned over the next 2 to 3 years. I thank you.